Global debt surges to a record $250 trillion in the first half of 2019, led by the U.S. and China. The Organization for Economic Cooperation and Development warns that corruption and child labor pose a risk in Congo's cobalt industry. Zimbabwe to cut value-added tax to boost consumer demand. Thank you and welcome to the program. I'm Chimeze Obi Iwagu. We get the show started now with the markets. And investor sentiments were mixed in Africa at intraday as the NSE sustained Thursday's gains, adding 0.07%. In South Africa, the JSE index traded lower by 0.20%. And the market in Egypt closed for the week negative on Thursday by 0.43%, while Kenya ended Thursday's session positive. And markets are closed today across the Middle East region as weekend begins on Thursday. However, stocks closed in the green on Thursday on encouraging corporate earnings. The Abu Dhabi index advanced 1.3%, with First Abu Dhabi Bank rising 2.9% and telecoms operator Etisalat gaining 0.4% at the close of their trading sessions. Dubai's index closed 1.9% higher, with its largest lender Emirates MBD surging 5.9%, and the Qatari index was up 0.8%, with the Gulf's largest lender, Qatar National Bank, and Qatar Fuel both increasing by 1.9%. The closing negative was the Saudi Arabia index, which edged down 0.1%, with 7 of its 11 banks slipping. In Europe, stocks traded higher on Friday morning as traders digest optimistic sounds out of the White House on a prospective trade deal between the U.S. and China. However, there are other interesting market-moving stories on the wire, and Chelsea will feed us in. Good afternoon, Chelsea. Well, the report released by the International Institute of Finance on Thursday showed that global debt surged by $7.5 trillion in the first 6 months of 2019. How is this report being read in Europe, even as the IMF warned that almost 40% of the corporate debt in major economies such as the US, China, Japan, Germany, Britain, France, Italy, and of course Spain was at risk of default in the event of another global economic downturn?
Well, regulators and economists have really been sounding the alarm on this global debt risk for several years now. Some have called it the next subprime bubble because there has just been such an enormous increase in the level of global debt. Whether we're actually heading to a meltdown in the corporate debt market or the public debt market it's not quite clear yet. It's certainly a risk, especially given the other economic headwinds that the global economy is facing. So especially in countries that are quite vulnerable economically, any sort of upset or any sort of change in the debt market could have a wide ripple effect. In Europe, this risk is seen as slightly contained, not as widespread as in the US and China or in Latin America, where a lot of companies have just been taking on so much debt. But there are definitely problem spots. You mentioned Italy, France, Spain. They all have seen a pretty big increase in both public and private debt. And this has really put a lot of pressure on the European Central Bank to consider raising capital buffers for the companies, especially for banks, so they would have something to sort of tap into if the market does turn. So I think reports like this, which are going to continue to come out, are just going to sort of put more pressure on the central banks to take action.
In Germany, where you are, a new survey from Deloitte of chief financial officers showed Germany companies' investments are at the lowest level in 7 years. What could a drop-off in corporate spending mean for the German economy as it teeters around recession?
If we see any further declines in investment here, it could have pretty profound economic impacts. Investment is really seen as the foundation of economic growth, and it's a really significant driver of the economy here. But I think it's hard to really imagine either the public sector or the private sector significantly increasing investments. There are a lot of obstacles on both sides. On the fiscal side, the German government has been very, very resistant resistant to in any sort of increase in investment. They've gotten a lot of pressure to increase investment in infrastructure, in digitalization, to consider tax incentives and things like that for companies. But they basically said we don't need this right now. And on the private side, businesses are really facing a lot of negative headwinds right now in the global economy, especially in the manufacturing sector, which in this survey, that was where we saw the majority of expectations and willingness to invest come down. And given how tenuous the economic situation is, it's hard to imagine companies really using really big investments at this point.
And in corporate news there, Alphabet's Google says it will stop telling advertisers some information about users' internet browsing after drawing scrutiny from the EU for privacy violations. Is this enough to appease EU data authorities?
It's certainly a step in the right direction for Google. Google has been targeted many times by EU data regulators and antitrust regulators for privacy violations. So they're really under attack from all sides here in Europe. They said that this came after discussions with regulators who have raised a lot of concerns about this program in which Google will give information about what websites users are looking at to advertisers. But I think there are still a lot of concerns even after Google has taken this step to sort of pare back the data they're offering. A lot of privacy activists are saying today this doesn't go nearly far enough because they're still providing location data. They're still providing identifying characteristics that would allow Google and the firms bidding for advertising to sort of know who the people are. So I think they're going to continue to face a lot of privacy-related scrutiny from EU regulators.
Well, I'm sure you're ready to take a breather after working so hard in the week. I'll say enjoy the rest of the weekend. Thank God it's Friday.